So hi guys, welcome back to my channel. In today's video, we are going to be debunking money and credit myths. These are things that I have heard so many times in the past. You've probably heard these too, or you might even believe some of them. But before we dive into my list, if you are new here, welcome. My name is V. I am a personal finance writer. And on this channel, we talk about all things money, mostly how you can live a more frugal life, but also how you can be more financially confident and improve your entire financial picture. So if you like these types of videos, hit the subscribe button and also give me a thumbs up if you hear something that you like, something that's new, or if you just want to support my channel, because your likes and comments, they are a big deal. It really helps with the growth of my channel and it allows others to discover my videos too. So the first myth that we have to clear up is that it's okay to only pay the minimum. And this applies to credit cards because there are some people who think that if they max out their credit cards or if they ring up a huge balance, as long as they're giving the credit card company their $25 or their $50 a month, that they're good. But that is not always the case. To be clear, making your minimum payments, it will keep your credit in good standing because the bank, they're going to report that you're making on-time payments. And yes, that does look good on your credit report. But if you want a really high credit score, and I'm talking about a credit score in the upper 700s or the 800 range, paying just your minimum is not always enough. And this is because several factors make up your credit score. And this is something that some people do not realize. Now, your payment history makes up 35% of your credit score, which is a big chunk, but it's not the only big determining factor. According to Experian, your credit utilization ratio, or the amount you owe, also makes up about 30% of your credit score. Now, credit cards are a type of revolving credit. And for anyone who doesn't know, credit utilization ratio basically looks at the amount of revolving credit that you're currently using in comparison to your credit line. And as a general rule of thumb, you really want to keep this ratio low because having too much revolving credit can hurt your credit score. This actually sends a signal to credit scoring models that you are a risky borrower. And unfortunately, your credit score will suffer as a result. So the best thing you can do with credit cards is don't carry a high balance. As a general rule of thumb, your credit card balances should never exceed 30% of your credit line. So going forward, it is so important that you only charge what you can afford and you pay off your balances in full every month. Another myth is that checking your own credit will hurt your score. And this is a myth that a lot of people believe. And because of this, they never check their credit report and they never check their credit score. But the reality is only hard inquiries will hurt your credit score. And these refer to credit checks that a lender or a bank makes after you submit an application. So checking your own credit is harmless. And in fact, it's actually recommended. Personal finance experts recommend that every consumer checks their credit report at least once a year. And there are different ways to do this. Some people will go to annualcreditreport.com where you can get all three of your reports in one place, or you can contact the bureaus individually to get your reports. The important thing is that you check and you make sure that all information is accurate, especially if you plan on applying for a loan in the near future, because having errors on your credit report or being a victim of fraud, both factors can drive down your score, which can make it harder for you to get approved for financing. The third myth is that you need a 20% down payment to buy a house. And yes, once upon a time, 20% was the traditional down payment amount, but things have changed, and nowadays it is very possible to get a mortgage with far less money. Now, I will say there are definitely benefits to saving 20% because having a down payment of that size, first of all, it means that you are able to avoid private mortgage insurance. And if you're not familiar with this term, this is an insurance that you pay that protects your lender in the event of default, and it's added to your mortgage payment every month, so it increases your monthly costs. Now, the good thing about private mortgage insurance is that it's not always permanent depending on your loan program. If you have a conventional loan, your lender will likely waive this once you have 20 to 22% equity. On the other hand, if you get an FHA home loan, which is another popular program, mortgage insurance is usually for the life of the loan depending on your down payment payment amount, and if you have to pay it, the only way to get rid of it would be to refinance your mortgage. So yes, saving a 20% down payment has its benefits, but let's be honest, that is a lot of money to save. And for a lot of people, even if you were to make some serious sacrifices, it could take years in order to have that type of money in the bank. And even if you are able to save this amount, by the time you're ready to buy a house, home prices could increase, interest rates could go up, and you end up just spending a lot more in the long run. So for anyone who's looking to buy a house now, the good news is that conventional loans require down payments as low as 3 to 5%, and with an FHA home loan, you can get a down payment starting at 3.5%. Another myth is that you need a lot of money to invest in the stock market, and this is something that I used to think a long time ago. And the reason why is because whenever I would observe conversations about people talking about investing and the stock market, it was always people who I knew were doing well financially. So I always assumed that to get started with investing, you needed a lot of money, which is not the case. The truth is, you could start investing with as little as $100 or less, and there are so many digital platforms that make this so easy, especially if you are a beginner who's looking to get your feet wet. For example, there's an app called Acorns, which I have spoken about on other videos, where basically you link the app to your debit card or your credit card, and every time you make a purchase, the app, it will round up your purchases to the nearest dollar, and it will invest the change for you. And the reason why I like this app is because in addition to your roundups, you can also transfer money into your account at any time, and you can even set up reoccurring transfers. And this isn't the only option. I also use Robinhood, which is also user-friendly, and in my opinion, it's probably one of the best for beginners. And other options include Webull, you can use robo-advisors, or you can open an account with an online brokerage firm. And one good thing is that a lot of these firms, they allow you to get started with only a few $100s, and sometimes there isn't a minimum to open an account. Another myth is that you need good credit to buy a house. Now, in my opinion, I do recommend waiting until you have good credit before buying, because this is going to help you get a low interest rate. But if you are eager to buy now and you have the income, know that it is possible. There are a lot of mortgage programs that will allow you to get approved with a credit score in the low 600s and the 500s. One option is a conventional home loan. You can actually get approved with a score as low as 620, and that's like an average okay score. Now, if your score is lower than this, you can get an FHA home loan with a score as low as 500 to 580. But I want to be clear, even though these programs will allow you to buy with a low credit score, your recent credit history must be good. So the provision, it's designed for people who have made credit mistakes in the past, but they're currently on the right path. And requirements do vary from program to program, but typically, if you want to get approved, you can't have any late payments within the previous 12 months. And another thing to keep in mind, if you have had a foreclosure, a bankruptcy, or even a short sale, there is usually a wait period before you can buy a house. And this wait period, it can range from 3 to 7 years, depending on the situation. Another myth is that you do not need an emergency fund if you have a credit card. And this is something that I have heard people say over and over throughout the years. They view their credit card as their emergency fund, and in their mind, as long as they have the card and as long as they have a lot of available credit, they don't have to save. But I have to say, there is a big difference between using a credit card for a one-time emergency expense and living off a credit card for several months. Because let's be honest, if you lose your job, it could take several months before you're able to find work. And even if you qualify for unemployment, it might not be enough. And if you do not have a savings account and you're relying on a credit card, you could easily charge thousands on your credit card over the course of looking for a job. And once you get to a point where you have thousands of dollars on your credit card because you're living off of it, I mean, even once you find work, it could take years to get rid of this balance. And during this time, you could easily pay hundreds of dollars in interest. So the bottom line is that having an emergency fund is always best. And yes, watching your savings drop so drastically after a job loss, you know, it can hurt, but that's what it's there for. And it's a lot better than having a huge debt hanging over your head. So there you have it. That's my short list of common money and credit myths that people need to stop believing. I really hoped you enjoyed this video, and if you did, please give me a thumbs up. And again, if you like personal finance content and you want to see more videos like this, hit the subscribe button so you can receive more tips on how you can live a more frugal life. I post every weekend and sometimes during the week. So thank you again for watching, and I'll see you in a few days.